Hello everyone, my name is Muhammad Aditya Fernanda. I'm from Group 1, and today me and my colleagues, Jessica Amula Manalu and Daniel, will present to you about the risk and return from investing. So why do we need to calculate the risk and return from investing anyway? How can we predict the future? Well, although there is no guarantee that the future will be exactly like the past, a knowledge of historical risk-return relationship is necessary as a first step for investors in making investment decisions for the future. Furthermore, there is no reason to assume that relative relationships will differ significantly in the future. And so now we learn about this thing. Firstly, we're going to learn about return. So return is basically the motivating force in the investment process. It is your reward for undertaking the investment. And return from investing is very crucial to investors. It is what the game of investment is all about. The measurement of realized or historical return is crucial for investors to evaluate their investment performance or evaluate their investment manager's performance if they had one. So it is also significantly influences future return estimation. So basically return consists of two components. The first one is yield. Yield is basically consists of the basic component investors think of when they discuss return. Basically things like whether the cash flows or income on the investment, either interest from bonds or dividends from stocks. The distinguishing feature of these payments is that the issuer makes the payment in cash to the security holder. So what is yield exactly? Yield is defined as yield actually measures security cash flows relative to some price, such as the purchase price or the current market price. So the next one is capital gain or loss, which is the appreciation or depreciation in the asset price. In the case of an asset purchase for the long position, it is the difference between the purchase price and the price at which the asset can be or is sold. And by combining these two components, we could form the total return, which is return from yield plus the return from price change, where the yield component can be 0 or positive, and the price change component can be 0, positive, or negative. And next is I'm going to talk about how to measure returns. First one is total return. Um, so is total return relates all of the cash flow received by an investor during any designated time period to the purchase price of the asset and is calculated as this equation, which is cash flow during the measurement period plus price at the end of the period minus the purchase price at the beginning of the period divided by the purchase price at the beginning of the period, or can be also said as the cash flow during the measurement period plus the change in the price during the period divided by the beginning price of during the beginning price of the asset. So basically, it is a percentage measure relating all cash flow on a security for a given time period to its purchase price, conventionally reported as return. It is the basic measure of the income earned by investors on any financial asset for any specified period of time, generally stated on a percentage basis. It facilitates the comparison of asset performance over a specified period, whether the comparison is of different assets such as stocks versus bonds, or different securities within the same type, such as several common stocks. And now I got a few examples here. First, on the calculation of bond return, where we assume the purchase of a 10% coupon treasury bond at the price $960, held 1 year and sold for $1,020. So how we calculate it would be 100 plus 10,020 minus 960 divided by 960, where we could get a value of 0.1667 or 16.67%. The second one is stock return, where we calculate the 100 share of data shield are purchased at $30 per share and sold 1 year later at $26 per share. A dividend of $2 per share is then received. So we can calculate it by 2 plus 26 minus 30 divided by 30, which results in minus 0.0667 or minus 6.67%. And next, we have the cumulative wealth index. So what is a cumulative wealth index? Well, basically, cumulative wealth index is the used to measure the cumulative effect of returns compounding over time given some stated initial investment, frequently shown as $1 for the convenience. And the cumulative wealth index is always stated in dollars and represents the effects of compounding returns over some period of time given any initial investment. So basically, it is how we measure how one's wealth changes over time. And the formula is right here, which is the beginning index value times the 1 plus the periodic of R's in decimal form, which is the 1 plus R could also called as a return relative. So the formula is basically the beginning index value times the return relative, where N is the end of the period. And we have a few examples. We have an example right here where we can calculate the cumulative wealth per $1 invested in 1990s to own common stocks using the S&P returns table, which is on the right side over here. And the cumulative wealth index for the decade of the 1990s would be, using this formula, we can calculate it and insert the value inside of the S&P returns table where we could get 5.23. This means that a $1 investment at the beginning of the 1990s would have grown to $5.23 by the end of 1999. The same method can be applied to any starting amount. For example, $10,000 invested under the same conditions would have grown into $52,300, while $37,500 would have grown to $196,125 by the end of 1999. And next, I'm going to talk about international returns and currency risk. When investors buy and sell their assets in other countries, they must consider exchange risk or currency risk. What is a currency risk actually? Well, currency risk, or also known as exchange rate risk, is the risk of an adverse impact on the return from a foreign investment as a result of movement in currencies. Depending on the situation, it can be favorable or unfavorable for the investor. So how does it affect investors? So if the foreign currency strengthens while the investor holding the foreign asset, after selling the asset, the investor will be able to buy back more dollars using the now stronger foreign currency. The investor dollar-denominated return will increase. But if the dollar strengthens while the investor holds the foreign asset, after selling the asset, the investor will be able to buy back fewer of the now more expensive dollar, thereby decreasing the investor dollar-denominated return. And for example, in a year of phenomenal returns, the Brazilian market was up about 150%, but the currency adjustment for US investor was negative 83%, leaving a US dollar return of the year of approximately 67% instead of the 150%. On the other hand, the Japanese market enjoyed a 47% return, and the currency adjustment was positive 15%, resulting in a US dollar return of approximately 62% for the year. And how do we actually calculate the return in domestic terms or the currency adjusted return? So we use this formula, which is the return relative, or 1 plus RFA, where RFA is the return earned on the foreign asset in terms of foreign currency, times the ending value of a foreign currency divided by beginning value of a foreign currency minus 1.0. And now I'm going to show you some examples. Consider a US investor who invests in Walmex at 40.25 pesos when the value of the peso stated in dollars is $0.10. 1 year later, Walmex is at 52.35 pesos and the stock paid no dividend. The peso is now at $0.093, which means that the dollar appreciated against the peso. So first we could calculate the return relative for Walmex, which is 52.35 divided by 40.25, resulted in 1.3006. And then we will calculate the return for the US investor after the currency adjustment when and it will result in 1.3006 times 0.093 divided 0.10 and minus 1.0, which will result in 0.2096 or 20.96% return in US dollar. And that's it for my part. And for the next part, I'm going to leave it to my colleague.
Hello everybody, this is Daniel, and today I'm going to talk about the summary statistics for return risk and measuring risk. These topics are critical because they help investors make informed decisions by understanding both the potential rewards and the risk associated with different investments. So, what are returns? The definition says returns represent the gains or losses from an investment over a specific period. To understand returns in a more detailed manner, investors use summary statistics. One of them is the key, I'm going to talk about the key statistics for return. One of them is mean return. This is the average return over a period. It helps us understand the typical performance of an investment. Another one is the variance and standard deviation. These are measures of how much return fluctuates over time. If returns are stable, variance will be low. If returns fluctuate significantly, variance will be high. The next one is skewness. This measures the asymmetry of returns. A positive skew means that there are more extreme positive returns, while negative skew indicates more extreme negative returns. The next one is kurtosis. This tells us how heavy or light the tails of the returns to distributions are. High kurtosis means a greater chance of extreme returns, both positive and negative. Why are these important? These statistics provide a quantitative summary of past investments performance, offering insight into potential future behavior. So now mean versus median return. Mean return is sensitive to extreme values like outliers. If something's really points out and is different to all the others, and median return less sensitive to outliers because it's in the middle of all return, providing a central tendency. Yes. And standard deviation and variance. Standard deviation shows the average spread of returns around the mean, how close they are to the mean of return, and variance reflects the volatility of returns, a key factor of risk assessment. Then we have the variance and the formula of it, and it helps investors understand variability in returns. Now, introduction to risk. What is risk? Risk in finance refers to the uncertainty regarding the future returns of an investment. It's the possibility that actual return will differ from the expected return. Then there are types of risks. The first one is systematic risk. This risk affects the entire market or broad range of assets. It's caused by macroeconomic factors like inflation, interest rates, or geopolitical events, or like the corona situation. And yeah, then another risk is unsystematic risk, asset specific, also known as specific or idiosyncratic risk. This risk is unique to particular company or industry. It could stem from management changes, product recalls, or sector-specific regulation. And systematical risk is unavoidable, while unsystematic risk can be mitigated through diversification. And the important part is that investors need to understand risk to manage portfolios effectively every day. Now we have risk factors. Factors affecting risk is volatility, degree of price movement in an asset, how much it moves inside of an asset. And interest rates changes can affect bond and equity returns. And we have economic conditions impacting the entire market, like a recession or growth, and company-specific factors like earning reports, leadership changes, things like that. And measuring risk. How do we measure risk? Understanding the risk is crucial, but measuring it is equally important for informed decision making. The key measures of risk are variance and standard deviation. Like I told you, just like with returns or variance of standard deviation are used to measure the spread of volatility of returns. A higher standard deviation means the investment is riskier because the returns fluctuate more. Then beta measures an investment sensitivity to movements in the overall market. A beta of 1 means the investment moves in line with the market. Greater than 1 means it's more volatile than the market, and less than 1 means it's less volatile. And the value of risk, for AR, estimates the maximum loss of investment, can face over a given period of certain confidence level. For example, a BRA of $1,000 at a 95% confidence level means there's a 5% chance that the investment will lose more than 1,000 over that period. And we have the Sharpe ratio. This measures the risk-adjusted return of an investment. It shows how much excess return you receive for the extra risk you take on. And a higher Sharpe ratio is better because it means you're getting more return of the risk you're taking. And we have the formula of better here, and a real world example compares standards deviations of stocks versus bonds. Yeah, I already explained better. And the Sharpe ratio as well. We have also the formula here. And now to diversification and risk. Diversification is spreading investments across different assets to reduce unsystematic risk, because if you spread your investment to many different companies, to different levels of stock, to real assets and digital assets, you can spread the risk of them losing money. And it's always a good thing to spread the risk. And you can do it by combining stocks and bonds in a portfolio. You can also use ETFs, because ETFs is ETFs portfolio managers uses little amounts of assets from a lot of companies and puts them together in one. And so the risk of all of them going down at the same time is very low, because it's spread above many different companies. And yeah, so that's ETFs. Risk return trade-off. Higher risk often leads to higher potential returns, and there are stocks, bonds, real estate, etc., where stocks are high risk assets and typically offer higher potential returns, while compared to the lower risk assets such as bonds and real estate often have lower risk with them. So that's my part for today. Thank you for listening.
Now I will discuss about the realized returns and the risks from investing. And it shows the explores the returns and risks of investing in major US financial assets and how these measures are typically used to present data of interest to market participants. So in this table, table 6.6, it shows the annual returns for major financial assets from 1926 to 2010. This includes both nominal and real returns, and shows the comparison of data from Ibbotson Associates and Jack Wilson and Charles Jones. And it also shows the large common stock from S&P's 500 Composite Index has a geometric mean of annual return of 9.6%. And for the arithmetic mean for annual return for large stocks, it is 11.4%. And the best estimate of the average return for stocks in any year is 11.4% based on the arithmetic mean. And for the standard deviation of large stocks for 1926 to 2010 is 19.9%. As you can see in this table 6.6. And for the difference between these two means is related to the variability and the stock return series. The linkage of between the geometric mean and the arithmetic mean is approximated by 610, this equation. And you can see here, it is the geometric mean, and for the AM is the arithmetic mean, and for the SD is the standard deviation of the arithmetic series of returns. And we can insert the formula if we already got the geometric and the arithmetic mean. And we can get also the arithmetic series of the standard deviation also. So this shows that the corporate and treasury bonds have geometric means of 50 to 60% of the S&P's 500 Composite Index, but smaller risk. And the treasury bills also have the smallest return and standard deviations, and the standard deviation of financial assets reflect the dispersion of returns for 85-year period from 1926 to 2010, which smaller common stocks being riskier than S&P stocks, S&P 500 stocks. As I will give a further detail that the treasury bills have the smallest return of any major assets, 3.6%, and the smallest standard deviation. And the standard deviation reflects the wide dispersion in returns from common stocks compared to bonds and treasury bills. Now I will discuss about the cumulative wealth index, which is shown in the figure 6.3. It shows the cumulative wealth of major asset classes and cumulative inflation, which the amounts are rounded. And as you can see here, it is the formula. The ending wealth value of 2,420.46 for common stocks in figure 6.3 is the result of compounding at 9.6% for 85 years. So this is the formula that you can insert to find the ending wealth value. So figure 6.3 displays the cumulative wealth of major financial assets and inflation index number from 1926 to 2010. The S&P's 500 Composite Index showed that the stock dominated corporate bonds returns with cumulative wealth of 2,420, as you can see here, versus $130.66. The geometric mean was used to calculate the cumulative ending wealth. Next, I will discuss about understanding cumulative wealth as investors. And these are the formulas that I got from the book. The CWI is the cumulative wealth index, or the total return index for a series. And to get this number, you should find the cumulative dividend yield component of total return multiplied by the cumulative price change component and total return. And to get the CDY, if you can use this formula. And for the CPC, you also can use this formula if you got the CWF first or the CDY first. So this is an example where the CDWI for common stocks S&P for 85 years was $2,364 based on a geometric mean of 9.57% for that period. The average dividend yield for those 85 years was 3.99%, raising 1.0399 to the 85th power. The cumulative dividend yield CDY was $27.82. Therefore, the cumulative price changes index for S&P for that period is $85. This is a compounding annual return of 5.37%. And this is how you find the 5.37% when you already got the CWI and CWI, CDY, and the CDY. So you can find the annual average of return. And to give more information, dividends have historically played a significant role in the compound rate of return S&P 500 stocks, accounting for nearly 42% of the total return. Of 3.99% divided by 9.57% from large stocks. However, dividend yields on the S&P 500 have been low and have their historical level, causing investors to earn more from the price change component of cumulative wealth or face lower cumulative wealth due to the lower dividend yield component. And lastly, I will discuss about what is compounding and discounting. And I will give you this figure. This figure 6.3 demonstrates the significant difference in the ending wealth between stocks and bonds to compounding significantly different mean returns over a long period. This concept was along of investment analysis. Compounding involves future results from compounding interest, which is used to calculate wealth indexes, and the present value or the discounting is the value today of a dollar to be received in the future, which must be discounted back to the present to be comparable. And that is all from us. Thank you so much for watching this video.